Right now, something very serious is happening in the United States economy, and most people don't even realize how fragile the situation has become. On the surface, everything still looks strong. The stock market is high, big tech is still dominant, and artificial intelligence is being promoted as the future of America. But underneath that shiny surface, deep cracks are starting to appear, and those cracks are getting bigger by the day. The reality is that the entire U.S. economic system is sitting on top of one enormous bubble built on cheap money and massive debt. This bubble has been growing for years. It was fueled by endless optimism about technology and the belief that innovation could solve every problem. But now, for the first time in a long time, that bubble is being tested in a very dangerous way. One of the biggest problems right now is interest rates. For years, American tech companies became addicted to easy money. When rates were near zero, borrowing was cheap, risk was ignored, and companies could raise billions of dollars without worrying too much about profits. That era is now over. The Federal Reserve has kept rates high to fight inflation, and with a new Fed chair coming in, there is a real possibility that rates could stay elevated for much longer than Wall Street expects. And that is extremely bad news for big tech, because the entire strategy of America's technology expansion over the last decade has depended on one very simple thing: cheap capital. Without cheap money, many of the biggest plans in the tech world suddenly stop making financial sense. Right now, American tech giants are trying to build infrastructure at a speed and scale never seen before in history. They want to construct massive data centers, entire fields of servers and processors, huge digital factories designed to power the next generation of technology. The vision is almost futuristic. Endless rows of machines, massive computing power, and a fully digital economy that dominates the world. But here's the problem. Building all of that requires unbelievable amounts of money, and that money only makes sense when borrowing is cheap. The U.S. approach to new technology has been very aggressive. The idea has been to build first and figure out the demand later, to throw trillions of dollars at infrastructure with the hope that businesses and consumers will eventually find enough uses to justify the investment. It is a build it now, monetize it later strategy. And that strategy worked perfectly when interest rates were near zero. But now, everything has changed. With rates staying high, that entire assumption is being challenged. If borrowing remains expensive, tech companies suddenly have to think twice about every billion-dollar project. They can no longer assume that cheap money will always be available. And that changes everything. Many of the investments that looked brilliant a few years ago suddenly look extremely risky. Projects that once seemed guaranteed now look like dangerous bets. One of the biggest examples of this shift is happening right now with NVIDIA. For months, there were massive rumors that NVIDIA was preparing to invest up to $100 billion into major technology infrastructure projects. The story was that NVIDIA would pour enormous amounts of capital into building the next generation of systems, effectively betting the company on future growth. But suddenly, that plan is falling apart, and expectations are being dramatically reduced. Now NVIDIA's leadership is backing away from those earlier expectations. What was once presented as a bold commitment is suddenly being described as nothing more than a possibility. The tone has completely changed, and that is a very ominous sign, because NVIDIA understands something very important. Committing that much money in today's environment is incredibly risky. There is no guarantee that revenues will grow fast enough to justify that level of spending. There is also no guarantee that investors will continue to fund the dream. In reality, what NVIDIA was considering wasn't even pure investment. It was something closer to vendor financing. NVIDIA makes chips. Tech companies need chips. So NVIDIA investing in those firms is basically a way to create artificial demand for its own products. It's a circular system. But circular systems eventually break when real demand does not appear the way everyone expects. The truth is that the United States does not even have the basic infrastructure needed to support this massive digital expansion. Huge data centers require enormous amounts of electricity. And America simply does not have enough power generation or transmission capacity ready to handle it. Upgrading the power grid, building new plants, rerouting energy supplies, all of that costs hundreds of billions of dollars on its own before a single server is even turned on. So the entire dream is running into a very hard wall called reality. And the financial side of this problem is getting worse. In 2026 alone, technology companies are expected to borrow around $150 billion just to keep funding their expansion plans. That is an unbelievable amount of debt being added to an already fragile system. And as more and more companies compete for loans, the cost of borrowing keeps going higher and higher. This creates a dangerous feedback loop. Higher rates make projects riskier. Riskier projects require more return to justify them. Higher returns require even more borrowing. And more borrowing pushes rates even higher. It is a cycle that can only continue for so long before something finally breaks. And it is not just NVIDIA that is facing these problems. Almost every major American tech company is now deeply committed to long-term financial obligations. The biggest corporations have signed massive long-term leases for data centers. They have promised to pay hundreds of billions of dollars over the next decade for computing capacity they hope they will need. Back in 2022, total future lease commitments from big tech were around $70 billion. By last year, that number had exploded to nearly $600 billion. That is an almost unimaginable increase in just a few short years. Those leases are the foundation of the entire bubble. Data center builders use those long-term contracts to borrow money from banks. They issue bonds based on the promise of future payments from big technology companies. As long as companies keep paying, the system works. But what happens if revenue doesn't grow fast enough? What happens if these companies realize they massively overestimated demand? The leases don't disappear. The bills still have to be paid. At some point, companies will stop throwing cash into what could become a financial black hole. And if that happens, the entire chain reaction begins. Data center operators lose revenue. Banks stop getting paid. Bondholders take losses. Borrowing becomes even harder, and the whole structure starts shaking. We are already seeing signs of panic. One major company suddenly announced that it needs to raise $50 billion this year just to fund its own projects. Think about that for a moment. A massive, profitable, global corporation doesn't even have enough cash on hand to finance its own plans. Half of that money will come from issuing bonds. The other half will come from selling new shares of stock. That is not a sign of strength. That is a sign of desperation. Even worse, investors are getting nervous. The cost of insuring corporate debt against default has skyrocketed to alarming levels. Credit markets are starting to question whether these massive investments will ever pay off. And some companies have already admitted that their cash flow will likely be negative for years because of these projects. This is what bubbles look like before they burst. But the tech bubble is only one part of a much bigger problem. At the same time that companies are borrowing insane amounts of money, the US government is facing its own debt crisis. In 2026, nearly one-third of all outstanding US government debt will need to be refinanced. That is about $9.6 trillion that must be rolled over into new loans. The Treasury does not have the money to pay that back. It must borrow again just to stay afloat. And with the Federal Reserve no longer printing money like before, the government has to find real buyers for that debt in the open market. The problem is that the profile of U.S. bond buyers has changed dramatically. Foreign central banks are no longer buying American debt the way they used to. In fact, many of them have become net sellers. Instead, private investors, hedge funds, and corporations are now the main buyers of U.S. treasuries. And unlike central banks, private investors are not loyal. They are chasing returns and can leave the market at any time. If yields rise or the dollar weakens, those investors can dump U.S. bonds overnight. That creates a very dangerous situation, because if Treasury yields stay high or rise further, the entire American economic model comes under pressure. Interest payments on the national debt are already one of the largest expenses in the federal budget. Bigger than defense, bigger than education, bigger than almost anything else the government spends money on. And that number keeps growing every single year. Right now, more than 27% of U.S. government spending is funded by borrowing. Soon that number could reach 30 or even 40%. That is not sustainable by any normal definition. And this is why, sooner or later, interest rates will have to come down. Not because inflation disappears, but because the debt system simply cannot survive high rates forever. At the same time, the U.S. government is trying to fight an economic war with China. A new plan has been launched to stockpile critical minerals like gallium, cobalt, and rare earth elements. The idea is to reduce America's dependence on China for key industrial materials. On paper, it sounds smart, but in reality, it raises huge financial and strategic questions that most people are not thinking about carefully. The project involves billions of dollars in total funding, including large government loans. And those loans come with interest rates higher than normal Treasury borrowing. So the government is taking on even more debt to buy materials that may or may not solve the real problem. Because China's advantage is not just owning mines. Their real strength is refining and processing. More than 90% of global rare earth refining is controlled by China. Stockpiling raw materials does not change that fact. And if the U.S. tries to artificially suppress prices or control supply, it could actually discourage domestic investment instead of encouraging it. So even the industrial strategy designed to fight China may end up making America's debt problem worse. All of this comes back to the same central issue. The United States is trying to do too many massive, expensive things at once. Build a technology empire, fight an economic war with China, rebuild supply chains, and fund a gigantic government deficit. And it is trying to do all of that while interest rates remain high. Something eventually has to give. Either rates come down or the bubbles start bursting. The tech bubble, the debt bubble, the economic bubble, they are all connected. And the cracks are already forming across the entire system. So the big question is this: can the US tech bubble survive in a world of expensive money? Can these massive investments really generate enough revenue fast enough to justify trillions in spending? And can the US government keep borrowing forever without consequences? These are the questions that will define the next few years. Because what happens next will not just affect stock prices or companies. It will affect jobs, pensions, savings, and the entire global financial system. The warning signs are flashing everywhere, and anyone paying attention knows that the road ahead is going to be extremely turbulent. As always, the smartest move is to stay informed, stay cautious, and understand the risks before it's too late. Because the era of easy money is over, and the real test of America's economy has just begun.